Something unusual happened while most investors were asleep. In the thin liquidity of the overnight session, silver made a sharp 425 move that immediately shifted the tone of the market. At first glance, a price jump is just a number. Markets move every day, but seasoned traders know that not all moves are equal. Timing matters, context matters, structure matters, and when a significant move happens during low-volume hours, it raises a different kind of question, not what happened, but who moved first? Overnight sessions are typically quieter. Institutional desks operate differently across global time zones. Liquidity is thinner compared to peak U.S. trading hours, and price can move more aggressively when fewer orders sit in the book. That environment can amplify volatility, but it can also reveal intention. Large participants often use these windows strategically. If they anticipate a broader shift coming, they begin positioning early, sometimes before the broader public narrative catches up. That is why this 77.425 move deserves attention. It may not simply reflect reaction, it may reflect preparation. To understand why this matters, we need to examine how silver behaves structurally. Silver is one of the most volatile major commodities in the precious metals complex. It tends to exaggerate moves compared to gold. When bullish momentum builds, silver often accelerates faster. When fear hits, it can drop more sharply. This amplified behavior makes silver both attractive and dangerous. It rewards timing but punishes complacency. So when silver makes an aggressive move outside of prime hours, experienced participants immediately look for confirmation signals, volume spikes, futures positioning changes, options flow, and key level interactions. One possibility behind such a move is a short squeeze. Silver futures markets carry significant leveraged positions. If price approaches a technical resistance level and pushes through it unexpectedly, short sellers may be forced to cover rapidly. That covering creates additional buying pressure, which drives price even higher, triggering more stop losses in a chain reaction. This cascading effect can create sharp vertical candles that appear sudden but are mechanically driven. If this 77.425 move was partly fueled by forced covering, it suggests that positioning had become crowded on one side of the trade. Crowded positioning is important because it reveals imbalance. When too many traders lean in one direction, the market becomes vulnerable to sharp reversals. Another possibility is institutional accumulation. Unlike retail traders, large institutions rarely enter full positions at once. They scale in gradually, often during lower liquidity periods where smaller order flow allows them to test depth without signaling their full size. If the overnight spike reflects strategic accumulation, then what we witnessed may be the early stage of a larger directional campaign. Institutions think in weeks and months, not minutes. Their moves often look quiet at first, then obvious in hindsight. It is also critical to consider the role of algorithmic trading systems. Modern markets are heavily influenced by quantitative models that react instantly to price thresholds, volatility triggers, and momentum signals. If silver breached a technical level that many algorithms track, such as a previous swing high or a volatility compression breakout, those systems could have flipped from neutral to buy mode simultaneously. Automated flows can intensify overnight moves because they operate continuously across global sessions. A cluster of systematic buying triggered at the same price band can produce dramatic acceleration without any visible headline driving it. The absence of a major news catalyst is itself telling. Markets often move before headlines appear. Economic data, geopolitical developments, or policy signals may have been anticipated rather than reacted to. Sometimes insider positioning anticipates macro data. Sometimes global markets shift subtly in correlated assets first, bond yields dip, the dollar softens, equity futures wobble, and silver responds as part of a broader repositioning. When cross-asset flows align quietly, overnight volatility in metals can be an early signal of macro transition. Beyond mechanics, psychology plays a central role. Silver traders watch key round numbers and historical resistance zones closely. If price had been compressing beneath a ceiling for several weeks, tension would have been building. Consolidation creates coiled energy. The longer price trades within a narrowing range, the more explosive the eventual breakout tends to be. If this $77,744.25 move pierced a boundary that had repeatedly rejected advances, then it represents not just a number, but a structural shift in control from sellers to buyers, at least temporarily. Liquidity dynamics are equally important. During thinner sessions, order books contain fewer resting limit orders. When aggressive market orders hit, price can jump multiple ticks quickly. That does not necessarily mean the move lacks legitimacy. It means conviction may have outweighed resistance. The key question becomes whether follow-through appears during higher volume sessions. If US or European markets open and buyers continue pressing upward, it confirms that the overnight move was not isolated noise. If price retraces sharply and volume dries up, it suggests temporary imbalance rather than sustained trend change. Historical precedent offers useful context. Silver has produced similar overnight bursts before major directional shifts. In prior cycles, early spikes sometimes preceded multi-week rallies as momentum traders joined institutional flows. Other times, they marked exhaustion points before swift reversals. Distinguishing between those outcomes requires examining broader positioning. Futures commitment data, open interest shifts, and option skew can provide clues about whether the move reflects expansion of participation or liquidation of prior bets. There is also the question of macro sensitivity. Silver sits at the intersection of industrial demand and monetary speculation. Overnight moves sometimes reflect developments in Asia, where industrial consumption data and currency shifts can influence commodity pricing before Western markets respond. If currency fluctuations weaken the dollar during Asian hours, that alone could have supported a metal rally. Conversely, if bond yields moved unexpectedly, precious metals may have reacted immediately. But beyond technical and macro factors lies a more strategic dimension. Markets move not only on current information, but on expectations about future policy. If traders anticipate changes in interest rate guidance, inflation trajectories, or fiscal stimulus, metals can move in advance. Inflation expectations, for example, play a powerful role in silver pricing. If forward-looking indicators suggest persistent price pressures, investors may accumulate metals as a hedge. An overnight repositioning could reflect emerging consensus around inflation resilience or currency risk. We must also consider sentiment extremes. When retail sentiment becomes complacent or overly bearish, contrarian forces build quietly. Sentiment indicators often lag price, but they reveal vulnerability. If traders had largely dismissed silver's upside potential, believing it range-bound, then a sudden move challenges that narrative. Narrative disruption is powerful. Once the belief that silver isn't going anywhere cracks, speculative interest can return quickly. Another structural layer involves derivatives exposure. Options markets can create gamma effects that amplify price swings. If large option strike levels were clustered near the breakout zone, crossing those levels could force market makers to hedge by buying underlying futures, accelerating the rally. This mechanical hedging can create powerful short-term momentum independent of discretionary buying. Importantly, we must separate magnitude from meaning. A $77,425 move sounds dramatic, but what percentage does it represent relative to silver's baseline volatility? Context determines whether this is extraordinary or simply elevated. If volatility had been compressed for weeks, then the breakout represents a regime shift. Volatility regimes tend to cluster. Once expansion begins, it often persists for multiple sessions. Traders who recognize early volatility expansion can adjust risk parameters accordingly. The behavior of correlated assets also matters. Gold, mining equities, and commodity indices often move in tandem with silver. If silver's overnight move diverged significantly from gold, it suggests unique drivers. If both metals advance simultaneously, broader precious metals strength may be developing. Mining stocks can serve as confirmation tools. When miners rally alongside silver, it reinforces bullish conviction because equity markets incorporate forward-looking expectations about profitability. Institutional risk models also influence reactions. Many funds allocate based on volatility-adjusted exposure. When volatility spikes upward but direction remains uncertain, some funds reduce exposure automatically. Others increase allocation if momentum aligns with trend signals. The interplay between these models shapes follow-through. The key takeaway is this: Overnight moves are rarely random noise. They may exaggerate due to liquidity, but they often reveal the earliest stages of a directional thesis. The market may be pricing in something before it becomes widely discussed. For silver holders, this creates both opportunity and risk. Opportunity if the move marks the beginning of sustained momentum. Risk if it represents a false breakout designed to trap late entrants. So what should we watch next? First, continuation volume. Does buying persist into major sessions? Second, structural support. Does price hold above the breakout zone on pullbacks? Third, positioning data. Does open interest expand, indicating new participation, or contract, indicating short covering? Fourth, macro correlation. Do bond yields and the dollar reinforce the move? The most important principle in markets is confirmation. One candle does not define a trend, but one candle can initiate a shift in psychology. The overnight 77.425 move has forced participants to reassess assumptions. Sellers who felt comfortable within a range must reconsider risk. Buyers who waited for proof now see potential. Uncertainty increases, and with uncertainty comes volatility. In financial markets, early signals are subtle. They rarely announce themselves clearly. They appear as anomalies, a spike at an unusual hour, a breakout without a headline, a surge that defies complacency. Whether this proves to be the beginning of a sustained revaluation in silver or simply a temporary imbalance will depend on what follows. But the significance of the moment lies in the break from routine. Routine trading breeds predictability. Disruption demands attention. Silver's history teaches that large trends often begin quietly. Before headlines declare a bull market, price structure shifts incrementally. Before retail enthusiasm surges, institutional positioning evolves. Before narratives change, charts whisper. The overnight move may be one of those whispers. For now, discipline is essential. Emotional reactions to volatility often lead to poor decisions. Experienced investors observe first, act second. They let the market reveal whether conviction builds or fades. The next sessions will tell us whether this was ignition or noise. What we can say with certainty is that something changed in that overnight window. Liquidity thinned, pressure built, and price broke free from its prior rhythm. Whether driven by short covering, algorithmic triggers, institutional positioning, or macro anticipation, the move has altered the immediate landscape. Silver is no longer trading quietly beneath resistance. It has announced itself.